I wanted to first thank you all for attending, and I want to thank the folks who helped me put this together. Olympia Nguyen over here and I are going to kind of tag team this today. Olympia is back at Stanford. She got a BS in computer science and then got a master's in management science and engineering, and then went off and worked on Wall Street and a bunch of other places. And we're really lucky to have her back to help try to build and grow this program that we have here, not just Pension Tracker, but other things that we do outside of that. I also want to thank the other folks who helped set this up. Celia Clark's over here. Ellen Moore just disappeared. Ben Murphy's over there. So if things go right, they deserve the credit because they're the ones who really organized this event today, so thank you. Appreciate the speakers who are here today. And I also want to thank the folks who are supporting this. This is supported by the Laura and John Arnold Foundation and also by the Crankstart Foundation and several individuals. A few other things I wanted to make sure I mentioned. First, this is an issue that is sometimes controversial, is somewhat controversial. And I guess I want to sort of, as much as I can, set the tone for today and set the expectations that this can be as collaborative as possible. That's the objective here. We want to, there'll be some disagreements, I'm sure, but at the end of the session and hopefully the end of this process, we'll actually have a healthier public pension system, not just in California, but around the country. We'd actually like to do more events like this around, not just around California, but around the country, because as I talk to folks out there, it's increasingly apparent to me that even people who study this closely, in particular folks in the media, don't really understand it that well. I'll give you an example. There's a reporter who was at the Marin Independent Journal back in my hometown who wrote on this for 30 years. He just retired about a year ago. And I remember when we released, I think it was our 2015 data on Pension Tracker, he called me, he said, this is great, what do I do with it? And he wasn't sure, and so I kind of walked him through and effectively wrote the story for him. And this is someone who'd been working on this for 30 years. So as much as we can be a resource to the folks who are here from the media, we hope to be, whether it's Pension Tracker, whether it's reports, whether it's reports from people like Josh Rao, who's going to be on a panel, or Jeremy Beulah, who's going to be on a panel later today, and other scholars here. We really want to engage you. One of the things that we may do today is we may use some analogies that are more apparent on the consumer side. I know that one person is going to talk about credit card debt. It's sort of, I think he's going to say that, the payments that are being made to pension systems today are like making a minimum payment on a credit card. Someone else will probably talk about mortgages. People may disagree with those analogies, but I know that those are some of the things that are going to come up today. The next thing I wanted to ask speakers, and I'll remind people as they come forward on this, if you could, since we're streaming this and recording this, if you could repeat the question just so that the audience can hear this as well. The last and most important item I want to mention is that the bathrooms are down the hall this way. If you need anything, just grab me, Olympia, any of the other staff here. If you need to use a phone, sneak away to an office, just let us know and we'll help you with that. And I just want to show you real quickly, so this is the Pension Tracker website that's up on the screen. Again, we've been doing this for a couple of years now. And I will say that, first off, one of the reasons that we've got, I think it's about 2 million data points on this, is because CalPERS in particular has been very helpful in providing data to us. I don't think that's how they would have responded a few years ago. I think that they've shifted their willingness to work with us, which I really appreciate. We have up until, for California, as you see here, we have up until 2015 data. We're going to add the 2016 as soon as we get it from CalPERS, because we're going to talk about it today, about when they're actually going to provide those files to us. We also have a U.S. site, and that U.S. Pension Tracker site, if you just go to pensiontracker.org, you can find that as well. And the U.S. site is structured the same way, and as you see here, you can look and you can compare and contrast funded ratios in Alaska with those in Alabama, with those in California, and so forth. So we're really, committed to expanding this, providing more detail. If you do use the site, we hope you use the site. Let us know your thoughts. I was looking at this the other day and I thought, we should really add this particular functionality. So if there are those sort of things, just please let me know. With that, I'll pass it on to Olympia, who's going to talk a little bit more about a couple of the other things that we do. Thank you.
So Mark and Joe have talked about how CPER can be a resource to you, but I'd like to also talk about how we use Pension Tracker as part of our research in policy briefs. So that can also be a resource to you. We analyze both liabilities and assets of pension plans. On the liability side, we calculate shortfall using Monte Carlo simulation. We also project contribution rates and also look at potential areas of crowd out in the general fund budget that could be due to rising pension costs and other special measures. So we've already finished one publication, which is for the City of Los Angeles. We have two more publications out for Palo Alto and CalPERS, which will be out in 4 to 6 weeks. So what I'd like to draw your attention to is to the graph on the upper left side, which is an example of our analysis on the liability side. So we broke down the general fund expenditures into 4 different categories. Capital maintenance.
Olympia, sorry, can you stay in front?
Oh, sorry. Capital maintenance, community services, general government, and public safety. As you can see, over the 10-year period, they've all fallen in terms of percentage of general fund expenditures. Although the percentages are small, the decreases are small, the aggregate dollar amounts are pretty large. They amount to $620 million as a percentage of general fund expenditures. And that's pretty significant given that last year's expenditures total $7.8 billion. On the asset side, we are doing an analysis of the San Jose Police and Fire and Federated plans. Here, we look at the assets and historical returns on a granular basis. If you look in the bottom left chart, in the 4th column, we look at returns, annualized returns over 1 year to 10-year to the 10-year historical horizon. So as you can see, for police and fire and federated, they both returned only 3.4% on an annual basis versus 7% of their assumed discount rate. That's a significant lag. Also, if you look at their returns versus their policy benchmarks and their peer group of plans with over $1 billion in assets, they're also lagging. So that tells us there might be some other underlying issues that might exist in the asset allocation or in their risk profiles. So we look at the portfolios on a granular basis, and I'll go over that in more detail in later slides.
Thanks. Okay, so I'm going to go back to this right here. All right, so the question that I'll start with is, why are we all here? No, is there a problem? Because I'm still surprised. Oh, sorry, full screen. Yeah. Yeah, thanks. So I'm still surprised at how many people I have conversations with who say, well, this is really not an issue, is it? Why are you spending so much of your time dealing with public employee pensions in California and elsewhere? And so I wanted to run through this, and part of what I'll do is I'll go back and I'll revisit that CPER study that my grad students did in 2010 to hopefully give you a sense of what's happened over the last few years, the last 7 years specifically. So again, there's this reluctance to acknowledge that the problem exists and that, in fact, it persists. I mean, I pulled these just from the last couple of months. On the left-hand side, this is a quote from someone who wrote something back in July, and he said, quote, "The so-called pension crisis is a myth promoted by people who are either hostile to public employees, have a financial interest in moving from pensions to 401ks, or both." And so if it's okay with you, I'm going to quote President Obama, former President Obama. Come on, man. I mean, come on, man. Think about that. I mean, to suggest that people are actually out to get you or that there's some, ulterior motive. I mean, I'll just tell you my background. So by any, I think, stretch, I mean, one of my former constituents, a couple are here, Andy Matheson and Ken Broad are here. I think most people would consider me a pretty liberal Democrat, no? And I actually come from a family of public employees. My mother, my father, my two brothers are all either were or are public employees, including my younger brother, who is still a firefighter. So, and I'm really proud of the work that they did and are still doing. And my objective, in part, is not for them specifically, but I think unless we do something, this system may not survive. And certainly we've seen that there are cases out there where people are losing benefits, whether it's through bankruptcy or because of non-payment of premiums or something along those lines. So it's really important for us to get rid of that. And I can tell you from my political experience that I knew that I was winning something when someone resorted to those sort of personal attacks. And again, there's no reason for anyone to do that. I mean, I'm hoping what everyone will be able to do here today is just focus on the facts, focus on the math, focus on the way out, because it's in our collective interest to be able to do that. The other thing the other article that I saw was, this just appeared a few days ago, and it was a commentary in the San Diego paper, "Why Full Funding of Pensions is a Waste of Money." And the argument there essentially is, you don't really need to be 100% funded. It's okay if you're 70 or 80% funded, that's just fine. Well, the folks at CalPERS still have a 100% target. Most people still have a 100% target. And again, I think it's really critical that everyone at least come to a consensus that there's a certain level of funding that's required to ensure that those people, who are expecting retirement checks get them, and also so governments and taxpayers aren't squeezed and other programs aren't crowded out. I'll talk a lot about crowded out later today as well. So again, it's useful to revisit this earlier SEPA work. I had the pleasure of being able to supervise 5 grad students here 7 years ago. And they've all gone to, startups and, World Bank and wherever else in the last 7 years. And they actually, at the request of Governor Schwarzenegger, decided to look at the big systems in California, CalPERS, CalSTRS, and the UC system. And they did that because Schwarzenegger said, I don't really know what the truth is here. One person tells me that there's a big problem, other people tell me it's nothing to worry about, what do you guys think? And they concluded that the unfunded liability was much larger than most people thought. So yeah, I wanted to go back and sort of look to see what's happened since they did that study in particular. And so if you look here at this is just the CalPERS funded ratio. And again, I'm not picking on CalPERS. CalPERS is the biggest, and so maybe people refer to them more than others. But I went back to 1993, and this is perf only. This is essentially, it is by far the lion's share of the CalPERS system. But it's a public employee retirement fund only. And you see that funded ratio, and again, the funded ratio by most people's metrics ought to be close to 100%, because then you know that over the long term, you're going to have the funding to be able to satisfy the requirements of the beneficiaries who retire. And so you saw in 1999, state benefits expanded greatly with Senate Bill 400. I always like to say I wasn't there when that was voted on, so you can't blame me for that. But you can. I was on a panel with Willie Brown, and I said, you can't blame me, and Willie Brown said, you can't blame me either. He said, I wasn't there either. He says, but I would have voted for it. He said, I would have marched it through because it was good for my constituents. A couple of years later, I voted for a bill that gave the same sort of benefits at the local level. Why did I do that? Because every single person at the local level, every agency in Marin and Sonoma counties, my old district, said, yeah, I really want to, we've got to have this to match the state plans. .com crash came along, Great Recession. So the CPER study was there. They actually looked at, the study was in 2010, but the last data they used was from 2009. And so at that point, this was about 60-something% funded. And as you see over time, even with PEPRA, the Reform Act from just 3 years ago now, you've got pretty level funding. The funded ratio hasn't really changed all that much. So, and what I think is most concerning to a number of people, including myself, is that even though we've had a fairly good economy during this period, we still haven't been able to climb out. Now, some people will say, don't worry, we're going to get there in 30 years, or we're going to get there in 40 years. There are others who will argue just as strongly that that's, the odds of that happening are slim. So at any rate, we're about where we were when that study was done. The study that a lot of people criticized, I think, was actually pretty much on target. So the CalPERS funded ratios look pretty similar. You can pull this up on Pension Tracker. Just to save time, I'm not going to do that. And you see that this is for the city of Palo Alto on all plans. Again, when that study was done in 2009 was the latest data. It was about 51% funded, got up to about 69% almost, and is in the latest year. And again, we're adding this data to Pension Tracker soon. They got to 64%. Now, 64% is based on the assumptions that are used in that system. There are a lot of people you're going to hear from today who will argue that that's not a real number. That in fact, if you use more realistic assumptions and methods, that number might be closer to 40%. And I don't know of anyone who would argue that 40% is sufficiently funded. So again, I'm looking forward to having that discussion today as well. The unfunded liability for CalPERS, as you can see, the black, they were in the black back when SB 400 was passed, and then it continues on, very quickly had an unfunded liability of about, $40 billion or so after the .com crash. And then that red ink on the right-hand side shows they were about 150 billion. And again, these are the official numbers. These are not the numbers that have been adjusted for a discount rate. These are essentially what's been reported by CalPERS. So we're about 150 billion unfunded liability. Is that a lot of money? To put it in some perspective, at least, the general fund budget for the state of California this last year was about $124.5 billion, I think. And again, you'll hear from people today who will argue that 140 or 50 is not the real number, that it's much higher than that. In fact, on Pension Tracker, you'll see that we put the number on a market basis. We put the number on a market basis at about $1 trillion for California. So $1 trillion unfunded liability. And by the way, I'm not counting retiree health obligations, or so-called OPEBs, other post-employment benefits. You add those in, that number grows even more so. So the question is, I always think it's useful not to focus on the asset side. I remember years ago, I had a conversation with a senior official from CalSTRS, and he said, Joe, don't worry. This was after the 2010 report. He said, don't worry, we're going to invest our way out of this. And I said, well, what do you need to earn to invest your way out of this? He said, I don't know, but we'll get there, basically. And I said, well, the modeling we've done suggests that you need to earn 13 to 15% per year for the next 13 to 15 years, roughly. And then his response was, and this is actually what he said, well, we've always got taxpayers to go to. That's not optimal for anyone for obvious reasons. But the point of this slide is simply that it's not just about the asset side, it's about the liability side. And I know I've had discussions with folks at CalPERS, and I know they're trying, and others are trying to look at the liability side. And unless we deal with that side of the equation, I don't think we're going to solve the problem either. So this shows the share of the unfunded pension liability in California compared to the retiree health unfunded liability, which is in the green, and bonds, loans, and similar instruments to all state and local governments. So on the left-hand side, this is sort of what's reported. These are using, again, the numbers that you get from CalPERS and San Jose as the federated plan, and LA cities and county, and all the other independent systems out there. The pensions are about 1/3 of the problem, if you will, or 1/3 of the total debt that the state and local government has currently. But if you assume that pensions are going to earn 7+%, which is the assumption going forward, then you assume 5%, and I'm guessing that you're going to hear from some people today who will argue that that's probably still a little bit too high. 5%, then that pension share becomes almost 60%. So it's a much bigger part of the problem. So this is one of the reasons that I'll tell you that I continue to work on this, because it is this albatross around the necks of local governments and of the state government here in California. So the problem is not limited to California. Here's my good news for the day. We're about the middle of the pack in terms of funded ratios. If you compare California, all the systems aggregated in California with all the other states, I think we're number 27. So if you go to Pension Tracker, you can see here, this is funded ratio. DC is at the top. I think California's number 27, and we're about 70% funded, again, on an actuarial basis, using the numbers that are reported today. So probably doesn't make you feel better, but the message here is that this is a problem across the country, not just in California. Again, I wanted to go back to that Going for Broke report that my students did in 2010. They listed 6 recommendations, and I wanted to just take a minute to say, well, which one of these have been implemented? Number 1, adopt probability-based funding targets. That hasn't been adopted, as far as I know, anywhere. Number 2, at a minimum, funds should be 80% certain of covering at least 80% of liabilities, what they call an 80-80 strategy. And what most systems do today is when they set that discount rate, and again, we've got folks from different pension funds and pension systems here today that can tell you more, but they say, well, we're going to set it at the 50th percentile. In other words, we've got a 50% chance of earning more than the discount rate and 50% less than that discount rate. And my response to that is always, what if I told my kids that I was going to bet on a 50-50 strategy for their college fund? There's a 50% chance that we're going to earn enough money to put you through college. And I know there are arguments against that, but the point here is that I think that's a more cautious, maybe more conservative approach, and that certainly hasn't been implemented. Number 3, contributions of the normal rate. I think for the most part that's actually occurred. I don't think we have anyone taking what are called contribution holidays, which happened in the late 90s and early 2000s when a lot of pension funds said, we got so much money, we're not even going to contribute this year. So that's a good one. The next, amortize shortfall payments over half the duration of liabilities. The average duration of liabilities, present value basis, is about 14 years or so. So that would mean you need to pay off that unfunded liability in a 7-year period. That's not what happens. It's typically as much as 30 years. Sort of the standard is 30 years, which means that you have a 30-year period to pay off that unfunded liability. And there are all sorts of issues that are raised by that. Number 1, it's a great way to kick the can down the road, which may be the reason we're in the position we are today. So again, that hasn't happened either. Invest in less volatile asset classes. I'll leave that for discussions later today because people can talk about what's actually happened, because there are some that are de-risking, that are trying to, some that are in theory trying to be more conservative and cautious, and others that are use the baseball metaphor, swinging for the fences, because it's the only way that they can get to the discount rates that they've set. And the last one, offer employees a hybrid system. The only one that I know of is the UC system. The UC system now offers new employees the option of a DB, a defined benefit plan, or a DC, a defined contribution plan. And about a third of their new employees this last cycle opted for the defined contribution plan. A third of them said, we prefer the other one. Now, maybe it's because they think they're going to be with the UC system a few years, and then that's portable, they can take it with them. I'm not sure what the reason is, but that's the only case I know. So of these 6 recommendations, there are really only about 1.5 that have been implemented. So there are lots more, there's a lot more area for improvement. Yeah. Okay. Yeah. That's great. That's great. Look. No. Right. So I think that's great to hear, and I think that I sense the change in attitude out there. I mean, it used to be, that we have the CalPERS chief actuary here. His predecessor, I don't think ever wanted to be seen with me. And we'd get together for lunch and we'd go hide in the corner, right? And that changed over time. And I remember once he called me and he said, look, I need your help on something. I'm trying to get the board to do X. Can you help me steer them in that direction? That's great. And again, the people who are running these systems on a day-to-day basis, I acknowledge are working hard to turn this battleship in the right direction. I do. I think that, you mentioned political constraints. I think those political constraints are still there. One of the things we're going to talk about a little bit today is governance. As you know, Governor Brown hoped to implement governance reforms as part of PEPRA. That didn't happen. I think that's something that really needs to be done going forward. So with that, let me move on. Any other quick questions? Then I'll move on to the next panel. Okay, great, thanks. So let me go on to, so the first thing we're going to do is show you a video. And it's because Netflix is so cheap. No. Hang on a second, it's this one. It's on Firefox, yeah, I got it. Okay, so this is probably, it's one of my favorite videos. So Bill Sharp, who's here, who's on a panel later today, Bill put together this video a few years ago, not when you were the chief actuary. Okay, and so we'll start with that, and then I'll introduce the panel.
Hello, viewers. Welcome to the Managing Your Money show. Our guest today is Ronald Way. His fabulously remodeled house was featured in Sunday's home section in the Capital Herald Tribune. He has kindly agreed to talk with us today about the financial aspects of this wonderful project. It is a pleasure to have you here, Ronald.
The pleasure is all mine, Diane. And please call me Ron.
Okay, Ron. Now, I understand that you recently retired. What did you do before?
I was the state pension actuary. I did calculations about the amounts we owed, the required payments, and so on.
Well, that's a subject for another day. Let's talk about your project.
That's what I'm here for.
Okay, so how much did it cost to do such a fabulous job?
It wasn't cheap. I used the finest contractors, architects, carpenters, painters, and so on. The total cost was almost exactly $1 million.
And how did you finance that?
I was lucky enough to borrow the entire amount from a local bank. I took out a fixed-rate mortgage. The bank charges me 4% interest, and I have 30 years to pay it off. I make a fixed monthly payment each month for 30 years.
That sounds like a great deal. Can you pay it off early?
Absolutely. I can do so anytime I wish. And there is no prepayment penalty.
So you could pay it off tomorrow for $1 million?
Yes, I could, although I wouldn't do it.
Understood. So you have $1 million liability?
I don't think of it that way.
Why not? You borrowed $1 million and you can pay back $1 million tomorrow. Why don't you have $1 million debt?
Because I have a terrific mutual fund that invests in stocks, bonds, hedge strategies, and other types of investments. I figure that it will return 8% in an average year. As an actuary, I can calculate the amount I would need to have in this fund to make all my mortgage payments for the next 30 years, assuming that I make 8% each year. The answer is about $650,000. So I consider my liability to be $650,000. Looked at this way, the project was a great bargain.
I must admit that this puzzles me. Did you also think about the state pension in this way?
I sure did. And it made almost everyone concerned very happy.
Very interesting. Do all pension actuaries think this way?
Not all. But most of the actuaries who work for state pension funds do, and for years the Government Accounting Standards Board has said that this is the right way to calculate our liabilities.
That is very interesting. And do actuaries who work for corporate pension funds do this too?
Usually not. They have a different accounting standards board, all kinds of government regulations and so on. For my liability, they would probably use a number closer to $1 million.
And why do states do it differently?
Because corporations come and go, but we figure that states will be here forever.
I certainly hope so. But I'm still not sure that I see the reason for states or for you to think this way. Even though your mutual fund might return 8% in an average year, it will earn less in some years and more in others. You can guarantee that if you put $650,000 in the fund today, you'll have enough to make all your mortgage payments. Or am I missing something?
No. But over the long run I expect to get a return of 8%.
But that isn't guaranteed. It seems to me that there is a substantial chance that your mutual fund could run out of money before all the mortgage payments are made. And if that happens, who will pay the bills?
Well, by the time that might happen, I'll be long gone. So if we get unlucky, I guess the kids will be left holding the bag.
I guess so too. But let's move on. I presume that you have $650,000 in this mutual fund, and according to your logic, your liability is fully funded.
Well, not exactly. I only have about $500,000 there at the moment. So I'm about 77% funded.
I suspect some people would say that the debt is really only 50% funded. But let's not dwell on that. Let me ask you this. Do you plan to do any more remodeling?
Absolutely. I'm working on plans to spend another $1 million. But of course it will only cost $650,000.
And I'm guessing that you have about $500,000 for the project.
Good guess.
Well, I've got to say that I hope your kids are saving lots of money.
Unfortunately, they aren't. At the moment they are having trouble finding jobs.
I'm sorry to hear that. Let's hope things will get better somehow. Well, I see we are almost out of time. Let me thank our guest today, Ron Way, for sharing his interesting ideas about financing. Please join us again next week on the Managing Your Money show. Our guest will be a financial economist who will bring us ideas from the dismal science. Until then, I wish you all a good day and good money management.